Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Happy Friday. Hope you guys are doing fantastic and everybody's having a good holiday season. Well, the Federal Reserve finally increased short-term credit. After about 2 years of talking and almost 10 years, it's been 9.5 years since the Federal Reserve has actually raised interest rates. Finally happened this week. And rates actually finished the week unchanged, about where they ended last week. And that's a little bit counterintuitive. And so I thought it would be pretty important here for me to kind of explain what happened, because I've already gotten a bunch of calls, and you'll probably be getting either calls, or at least when you're in those holiday parties or things like that, clients might be asking you, hey, I hear the Federal Reserve is raising interest rates and rates are going up. And that may not actually, and that is actually not what is happening right now. And so I thought it would be good, again, just to give you a little bit of insight as to what's going on. Now, the Federal Reserve hike is going to affect credit card rates. Those are going up. Home equity line of credit rates, those are going up. Possibly auto loans and maybe some other short-term loans. Because when the Federal Reserve increases or decreases credit, what they're increasing or decreasing is what's called the Fed funds or discount rate. That's short-term money. If you were Bank of America and I was a Federal Reserve and you needed to borrow some overnight funds to meet your reserve requirements, that's what the Fed funds and discount rate is, or if you were borrowing from one bank to another. So it's just to meet their short-term reserve requirements. So that is going to affect some short-term money. Anything that is adjustable, very short-term adjustable, like home equity lines of credit or credit card rates, those things are going up. But that doesn't really affect long-term interest rates. Now, why they would be adjusting the short-term credit or tweaking credit is what is going to affect long-term interest rates. It's all about inflation. Inflation is the arch enemy of interest rates. The more the prospects are for higher inflation, or if inflation is happening, then long-term interest rates are going to get hurt. Now, the Federal Reserve typically will increase credit because they're worried about inflation. They want to keep the economy from growing too fast. And right now they've had a massively accommodative policy with basically zero interest rates for quite some time. So if the Federal Reserve feels like the economy is growing a little bit too fast, one way they might try to influence that is by increasing short-term credit. So it's more expensive for banks to borrow that money. They pass that on to consumers, and it kind of slows overall cost of, it slows borrowing and kind of puts a little bit of a drag on the economy. Now, this time, the Federal Reserve is not necessarily increasing credit because they're worried about inflation. For the very long term, what they might be, what I think they're worried about, most experts think they're worried about, is they want to have increased credit because when the economy falters in the future, they want to have some ammunition in their arsenal of ways to influence the economy to ease credit to help the economy. So they're just trying to get things back to a normal level. It's not because the economy is doing phenomenally well. So this was expected. The Federal Reserve increasing credit was expected. What the market was also looking at, and more importantly, is what are the comments that the Federal Reserve Chairman Yellen is going to say on how quickly they'll continue potentially to raise interest rates, and even more importantly for interest rates, will they continue to be buying mortgage-backed securities with some of the Federal Reserve's money, because they have this big pool of mortgage-backed securities that they bought when all this quantitative easing was happening. And as those things pay off, what are they doing with that money? Are they reinvesting it, or are they just going to put it back into just pay these things off and not continue to have this money back into the economy? So Federal Reserve increased credit, and what Janet Yellen did say is that they were going to have a very measured pace. Now, she did telegraph that it's very possible that over the next year there might be some Federal Reserve continued increases to credit, but they're going to be very measured on how they and when they increase credit again, or even if they will or not. And they also said that they will continue to buy mortgage-backed securities. So all those things actually helped long-term interest rates, and I think it will continue to help long-term interest rates. Now, if the economy does show that it is really increasing, then all that's later on this year, all that stuff could change. But for right now, the market expects that this probably won't be the last increase to short-term credit, but we're not going to see short-term credit continue to, rise maybe by 2 percentage points over the next 2 years or anything like that. The economy is not doing that great, and the Federal Reserve is still going to be in there adding money to buy mortgage-backed securities, and so that's going to decrease the supply, which keeps rates low. It keeps the yield lower. So those two things were actually really good for mortgage-backed securities and for interest rates. So when you're at those holiday parties or whatever you're doing, and people say, hey, I hear interest rates are going up, you can tell them, not necessarily. And actually, this should keep interest rates pretty low. Now, we never know when that's going to change. So if you're thinking about buying a house, now is a phenomenal time to do that. But don't think that interest rates just went up by 0.25% or whatever. That did not necessarily happen. So hopefully that helps. Hopefully that can help answer some of those questions. We did see some economic data that was released into the market, Consumer Price Index, which measures inflation. That showed no increase. It was 0. So it shows that there's really not any inflation to the consumer. The core number, which strips out food and energy, that did show an increase of 0.2%. So you've seen those gas prices. Gas prices are really low, and that's one of the reasons that that CPI did not increase. But even when you strip that out, there's not a whole lot of inflation going on overall because the core index is only up 0.2%. And that overall is good for interest rates. So hopefully that helped. We'll keep you informed, and we'll see how all this plays out over the next week or 2 weeks, and we'll always keep you informed. If you have any questions, please give us a call. If there's anybody that needs any help, if you're working this weekend, so are we, so give us a call, and we're happy to either explain this to a client or get someone pre-qualified. So thanks for joining me with Java with Jared. Happy Friday, and we'll talk to you soon, and again, happy holidays. Bye-bye.